Hello and welcome to Currency Point, presented by me, Evan Lucas, for FP Markets. As always, please have a very good read through of the disclaimer on screen. Everything in this video is general in nature, none of it should be relied upon as any form of advice. FP Markets does not know your personal scenario nor your personal financial goals, and therefore none of it should be relied upon as any form of advice at all. It's just general in nature only. This week, and I am looking at this week, we've gone through Jackson Hole, and Jackson Hole, as I expected, was going to be a bit of a non-event, and it is in terms of what we got out of their numbers and got out of their discussion. It tends to be a bit more of a sort of a love in these days than anything that's really there. Not surprised, because the end of the week we get another non-farm payrolls, and non-farm payrolls are probably and should be above 750,000 or even 800,000. Anything sub that, I'd be disappointed, in fact, in terms of how I look at it. CPI, PCE has come out at the end of last week for the second couple of looks. They're solid. PCE particularly sitting at 4.1. That's a long way up. Sorry, it's 6.6. It's a long way up. It's 4.1 better than what we would normally expect. So when you look at that from the perspective that we are into the month of September, the September FOMC meeting is this month, it's more of a likely time to actually hear them talk about what is going to be taper and how it's going to happen, when it's going to happen. It also is the first time we get a read for 2024. And why that matters, sometime in 2022 or 2023, it doesn't matter which sort of side of the fence you sit on, rates will be higher. At least that's exactly what they're telling us by 2024. And that 2024 figure should probably start to give us an estimate of what that might actually be. How high from the current range of the federal market will it be? And if you look at where they're currently sitting, the federal funds rate at 0.12 probably is more likely to be sitting towards 0.25, maybe even as high as 0.3 of 1% in those band ranges they give you, which is currently sitting between 0 and 0.25 of 1%. It won't be any higher than 0.75 of 1%, in my view anyway. So with all this sort of gusto around hawkishness, it'll be twofold. It will be, first and foremost, let's start taper, get QE out of the way, and probably finish QE before we even start talking about rate hikes. And they should be separated. I think that's very clear. I think the Fed has made it very, very obvious that they do not want them to be linked. They're not going to happen at the same time, and therefore you want quantitative easing to finish first before we talk about rate rises. And that therefore is why that 2024 figure, in my view, is going to be really important, because it makes us understand about probably also how long it's going to take to get out of taper. Also, looking at US data, remains pretty robust. Have a look last week. New home sales were slightly slower, but overall they're still expanding at quite a reasonable rate. Then you look at existing homes, and they're incredible in terms of what it's doing. They're also slowing, but the average price is $359,000 US dollars. That's a 17% increase year on year. And you're still seeing about 5.99 million homes to date go under the hammer this year. That's really strong by historical standards. So there's no doubt there is momentum there, there's stimulus there. If you look at also things like PMI numbers that were last week, manufacturing and services, although they eased, they're still at historically high levels in the 60s. And on the services, what caught my attention is employment. That is growing rapidly. Again, it gets back to non-farm payrolls, but also there's a confidence in the US that even with the Delta strain, that their economy is still powering ahead and they're doing what they should be doing. So I've been very strong on the US dollar for the whole year, and I'm not going to change today. And I still believe that. We have seen it ease out, and interesting enough, it did go against material stocks. That isn't surprising. I mean, I've highlighted the Aussie dollar, and I did a real big piece on it last week. Got into 71. It's back in 72, which is not surprising. RSIs had gone to oversold, same with MACDs. They've started to ease at the back end of last week. And as we look through this week, there is again that pressure on the Aussie, in my view, to push it lower. Same with the Kiwi, despite the RBNZ's talk of being a bit more hawkish. I just think at the moment, risk currencies are facing a tidal wave of US movement and US data. Looking across the Atlantic, 117 in euro dollar. It's holding on to that level quite strongly. The bulls just cannot pass through 117.2. But again, US data, US strength, the way they're handling the pandemic and the way the country is powering forward with sort of treating the pandemic suggests that it's a US dollar positive. And all that's why this week, again, just reassess your positions, because if there is that easing that we've been seeing on US dollar side, it just gives you that chance to possibly reposition again for as that we push through September, getting to the FOMC meeting, and therefore getting towards the end of the year as taper starts.